Hey, Dan Passarelli here. Well, the S&P 500, as measured by SPY, was basically flat today, down 0.01%, down a nickel on the day. You'd think that nothing even happened. And, well, a lot of things happened, but nothing really of major news. Actually, you look at this chart of the last 6 months and it kind of looks like nothing happened. We're about flat from exactly 6 months ago. Kind of weird. You look at the VIX, and it's down 1.44 today. That kind of seems like nothing happened. But let's talk about the VIX for a second. I use the VIX as what everybody else uses it for, a measure of investor fear. That's what they call it over at Barron's and the Dow Jones. They call it the investor fear gauge. And I look at it, I see it's down, and I think, okay, well, there's less fear. And there was definitely a lot less saber rattling today as far as the U.S., Iran, Israel whole fiasco is going. So I think, okay, things are okay. But that number's a little bit misleading today. And here's why. I've talked about this a long time ago in one of these daily videos, but it's a little different today, and you definitely need a reminder if you're looking at this the way I just described. Tomorrow, the market's closed. And tomorrow's Thursday. And then we open on Friday for one more day of trading, and then we have Saturday and Sunday that we're off. So in the next 4 days, let's see, Thursday, Friday, Saturday, Sunday. Yeah, in the next 4 days, there's only 1 day of trading. In the next 4 days, there are 3 days of Theta on the days when the market's not open. 1 day of trading, a total of 4 days of Theta. So what the market does is it takes some of that Theta out now so that it all doesn't just get crunched into the weekend, because that wouldn't make any sense. If the Theta actually came out like at the end of the day of every day, including Saturday and Sunday, then everybody would just sell the market on Friday afternoon and buy it back 3 days worth of Theta cheaper on Monday morning. So it couldn't work that way. The market takes Theta out in anticipation of a day off. So today's days, we're already trading on tomorrow's days, maybe even Saturday's days by now. And so that makes every option worth a little bit less by the amount of Theta. But the model that calculates the VIX doesn't move the days ahead, because that wouldn't make any sense for it to move the days ahead. That just happens sort of organically by trading. More selling pressure from people who don't want to be long options going into the weekend and lose 3 days of Theta. So all the model sees is that the option prices got cheaper. And so if the model was a person, I'm kind of personifying this model that calculates the VIX, even though it's just a bunch of numbers and plus and dividing signs, right? All the model sees is, option prices got cheaper. So, it must be that implied volatility is lower. And the way it calculates it, now back to not personifying it just as numbers, the way it calculates it is it looks at those lower option prices and it spits out a lower VIX. But it's not lower implied volatility, which is what the VIX measures. It's the fact that there's going to be 3 out of the next 4 days closed. So we got 4 days of Theta in basically 1 day of trading. So the point is, if you're following along, that the VIX looks lower than it is. So this looking at it and saying, the VIX is down today. Everything's fine. Everything's, going pretty great. That's a little bit misleading. In reality, I'd say the VIX isn't really even necessarily down today when we take that into account. So we get a day of passing where the world doesn't stop, but the market is closed, and then back at it on Friday. I hope that helps. This is Dan Passarelli, Trade Smart.